Assalamualaikum warahmatullahi wabarakatuh. Today we're from CS2486A, project number P18M22. We present our final year project entitled Measuring the Risk Profiles of Certain Business Sectors using Selected Risk Indicators and KMV-Merton model under the supervision of Madam Noliza binti Muhammad Yusuf. So, let's get started.
These are the team members for this project. The leader is Muhammad Nur Hakim bin Muhammad Rosli, followed by Masharah binti Ben and Nurul Ashura binti Abu. The first chapter is Introduction.
Good evening, I'm Nurul Ashura and I will start this presentation. Default risk management is important for safety measures before investing. Default risk is the probability that a borrower fails to make full and timely payments of principal and interest. Previous study concluded that while the KMV-Merton probability is a common default forecaster, it is insufficient to predict default. The sample performance of models that combine the KMV-Merton probability with other indicators is superior to those that do not. So, in this report, the KMV-Merton model and 6 selected risk indicators are used to examine the default risk of 50 firms in Malaysia from 2010 to 2020. Level of default risk of each firm will be determined, and risk profiles for all involved sectors in this research are then created. For the problem statement, investors should research the financial health of any firm they are considering investing in before making any decisions. For instance, COVID-19 had an effect on Malaysia's economy as default probability is not included in credit ratings provided by ratings organizations like MARC, which prevents investors from making informed investment decisions. KMV-Merton model may therefore be used to assess a firm's financial status before making an investment. Facing default risks are unavoidable, but having a way to assess default is crucial to minimize the impact of a possible crisis in the future. The objectives of this study are to analyze the level of default risk of firms using KMV-Merton model, credit ratings, and the selected risk indicators. The second one is to provide the risk profile of certain firm sectors based on the analysis in the first objective. The significance of this study is, before making an investment, it is essential to evaluate a firm's financial standing to lower the chance of losses. The study offers helpful information for calculating a firm's default probability. Default risk profiles are created for financial planners, investors, and stakeholders to understand and manage the risks they are facing in order to avoid huge loss. Scope and limitations of this project. This study will focus on predicting firms' level of default risk using the KMV-Merton model and the selected risk indicators. Several firms will be chosen based on the firm's data availability, which was gathered via Thomson Reuters data stream, Refinitiv Icon, and the annual reports of the companies. This study was done through purposive data collection, which was limited to Malaysia due to the course requirements' low cost and emphasis on non-financial firms. However, the accuracy of the prediction cannot be determined precisely and therefore act as the limitation of this study.
Next, Chapter 2 is Background Theory and Literature Review. Firstly, in literature review, according to Corporate Finance Institute in 2015, default risk is the chance that a borrower would not pay financial obligation as scheduled. A study by Park et al. In 2021 stated in the study that the purpose of default prediction is to control insolvency and minimize social costs. For our report, we selected 6 risk indicators to determine default risk, which is a leverage, liquidity ratio, volatility, firm size, return on assets, and cash. Firstly, leverage. According to Al-Khatib in 2012, leverage refers to a degree to which firms make use of their financial borrowings to raise profitability. Al-Khatib stated that higher leverage ratio is interpreted as higher chance of default when a firm borrowed a huge sum of money. A lower firm's debt means lower leverage, therefore less default risk. Study by Bonacorsi di Patti et al. In 2015 also stated in the study in which they found that higher leverage is corresponding with higher probability of default. Next is liquidity ratio. Liquidity refers to a firm's ability to pay short-term bills and debts and a firm's capability to immediately sell assets to increase cash. The study of Gould and Shaw in 2019 stated that because there is a presence of information asymmetry, short-term debt induced the increase of PD. However, based on a finding by Zhang et al. In 2020, they found out that firms with high liquidity falsely decrease default risk. According to Lalit Chandra ETAL in 2021, the analysis of liquidity ratio helps to evaluate the ability of a firm in paying its financial responsibility on time. Next, a study by Tang and Yan in 2010 stated that volatility is the most crucial determinant of default risk among firm-level attributes. It is correlated with Korea ETAL in 2017, in which they believe that volatility is the most significant variable to evaluate default risk. They also implied that greater chance of default is created from a higher expected volatility for a given asset value and capital structure. Moving on, a finding by Zhang ETAL in 2021 stated that firm size is negatively correlated with firm's default probability. In 2015, a study by Lee and Son claimed that since large firms get well-founded and high-quality information, which resulted in lesser cost of debt, the firm size is positively correlates with leverage. Return on asset refers to a financial ratio that measures a firm's profitability in relation to its total assets, according to Highgraph in 2022. In 2019, Wu ETAL claimed that it has a positive impact to distance to default. It is consistent with a previous study by Liang in 2012. Lastly, cash. In the study by Wang and Chu in 2019, the firm's ratio of cash holdings to total assets is used as one of the control variables in their research because cash acts as a tool to pay debt obligations, which they expect to be negatively associated with default probability. However, this is a contrary with the finding by Zhang ETAL in 2021, in which they claim firms that hold more cash are more likely to have decreasing distance to default.
The KMV-Merton model was created using the Merton model as a foundation. Merton made the assumption that a firm's entire asset worth follows the geometric Brownian motion as depicted in the equation on the left. Default is described as occurring when at the time the debt matures, a firm asset's market value is lower than its liabilities book value. Therefore, the default probability of firms is described as the equation on the right side of this slide. Next is the application of KMV-Merton model as seen in this slide. There are a number of studies related to the KMV-Merton model. These studies are comparable to ours, and all of them employ KMV-Merton model in order to calculate default risk. However, these studies differ in the main objective of our study of analyzing the level of default risk of firms using KMV-Merton model, credit ratings, and the selected risk indicators. Credit ratings. The capability of a potential debtor to fulfill financial obligations, whether they are from the government, a firm, or an individual in full or on schedule, is assessed by a credit agency and is represented by a credit rating, as stated by Zakaria et al. Meanwhile, Tan et al. Mentioned that each rating agency has a distinctive method for determining a firm's credit worthiness and default risk. Table 2.5.1 on the right shows the corporate credit ratings based on Malaysian Rating Corporation Berhad or MRC. It can be seen that the higher the rating is, the lower the default risk will be.
Moving on, Chapter 3 is methodology for the project.
The start of the methodology will be data collection. All data was gathered from non-financial sectors between 2010 and 2020, which included share prices, market value of equity, outstanding shares, short-term and long-term borrowing of firms. Sample of the data was taken from the Thomson Reuters data stream and Refinitiv Icon databases, firms' annual reports, with MRC databases as the source for ratings. The next process is to determine the default risk of firms using KMV-Merton model. The first step is multiplying each of the daily stock prices with the outstanding share to get the daily market value of a firm's equity. The second step is to calculate the daily book value of liabilities by defining it as a total borrowing of the short term plus half of the long term borrowings. Next is the third step, where the daily assets market value is calculated based on the sum of the firm's book value of liabilities and market value of equity. The first step will be to generate the daily natural log of the assets market values returns to get the average return and the standard deviation. The last step is calculating the distance to default, D, followed by estimating the annual default probability of firms using the equation below.
Next, for risk indicators, data is taken from the firm's annual financial summary, balance sheet, and income statement, where they are subject to availability. The figure shows the 6 steps to calculate each risk indicators.
Predicting the credit rating of selected firms. Based on the probability of default data gathered using KMV-Merton model, the credit rating for each firm was then predicted using the range of values shown in table 2.5.2. Next is estimating the level of default risk of firms. Information on predicted credit rating is used to categorize firms according to the level of default risk, which can be seen on table 2.5.4, with low, medium, and high level. Firm that has predicted credit rating of AAA, AA, and A is categorized as low. Next, firm with predicted credit rating of BBB and BB is categorized as medium level, while firm with predicted credit rating of B and C is categorized as high level.
Next, in 3.5, risk profile is constructed based on previous calculations. For example, table 4.3.1 shows the risk profile made for construction and engineering sector. These are the steps to create risk profile. We use data of predicted PD, rating, and value from selected risk indicators to create risk profile for some sectors and for all involved sectors. Next, chapter 4 is results and discussion.
In this slide, table 4.1.1 shows predicted probability of default results. There are several listed firms and their PD from 2010 until 2020. Table 4.1.2 displays the descriptive analysis for DD and PD values. Larger PD values are thought to imply a higher likelihood of a firm defaulting, which is supported by the maximum and minimum PD values for each rating category. As the rating declines, the average PD value rises. This demonstrates that there is an inverse relationship between default risk and credit rating. The results show that ratings for mean estimated probabilities of default and non-default are consistent. Furthermore, table 4.1.3 shows the possible range of DD and PD for each rating category. Comparing table 4.1.3 to table 2.5.2 of MRC default rates demonstrates the validity of our findings, as the range of the predicted PD are not that far off from the range provided by MRC.
I will proceed with the result in 4.2. Table 4.2.1 shows the firm's range for selected risk indicators. However, the range of each selected risk indicators may be subjected to each sector, thus we cannot compare the range between firms of distinct sectors.
Next, we move to 4.3 risk profile. The lack of data may affect the risk profile created, as there are limited and less variations of predicted PD rating and values for selected risk indicators. The predicted PD rating is still in the range of MARC probability of default rate. This means that the predicted PD is relevant. The data for each risk indicators also corresponded with our literature review, except for leverage ratio and volatility that does not have consistent range, hence it does not affect default risk. Finally, we reach the conclusion of this project. The first objective has been accomplished by obtaining PD using the KMV-Merton model formula. Based on the findings, the PD of assessed companies falls within the range of actual MARC ratings, which means hypothesis is accepted. Aside from that, the first default risk was also calculated using the selected risk indicators. Firm with relatively high liquidity ratio, ROA, and cash and big firm size is inclined to have lower default risk. Hence, these risk indicators corresponded with the literature review. However, there are firms that have high leverage and high volatility, but has low PD and vice versa. Thus, leverage ratio and volatility does not reflect firms' default risk. Meanwhile, the second objective is achieved by classifying the firms to 3 levels of default rate probability. Each risk indicator's range is included into each level. The result shows that the risk profiles are compatible with the actual rating. Some recommendations from us are, the number of firms and the period could be reduced for simpler calculation, as the less data there is, the less error possible to arise. But less data also means that less relevant the result is, as the scope is small. Nonetheless, there are other suggestions that ought to be considered for improved outcomes. Future researchers may choose to employ a different model in addition to the KMV-Merton model, such as the Moody's KMV model, the Altman Z-score model, or the Merton model.
That's all from the three of us. We appreciate you watching our presentation of our report. We hope our explanation gives light to your understanding of our final year project. Thank you.